Okay, you should be able to come into it. Share screen.
How's the weather in London right now? Is it sunny and all?
It is cloudy mixed with more clouds. But no, it's not bad. It's not bad. It wasn't as beautiful as it was a couple of months ago.
Mm.
You know, the lockdown sunshine that we were all accustomed to, typical.
Yeah.
You can't leave your house, it's boiling hot.
Mm. Okay, we have quite a number of people who have joined our webinar right now. Yep.
That's great. Give it 10 more seconds just to get everyone else in.
Yeah.
Right. Okay. Right then, I will begin, and if anyone joins a bit later on, then that's absolutely fine. Okay, so thank you everyone who has joined today. My name is Holly and I'll be moderating today. So we are joined by our expert panelists today. So we have Dennis Chan, who is based in Dubai. He is our head of sales for properties outside of the UK. So he manages all of our teams, including Dubai. And then we also have Sebastian. He is our head of international off-plan sales in the UK. So he is ready to support clients if yourself are in London or the UK. Hi Sebastian, nice to see you. And then we also have Sohail. He is our expert mortgage specialist, and he works in-house with us, so he can support with all of your mortgage queries that you have for any properties as an overseas investor or a UK-based investor. So today's webinar is really kind of, we want to open up the table to discussion. So at any point throughout the webinar, we'd love to take your questions and to get involved in the conversation. So it's going to be very very relaxed, and we're kind of looking forward to hearing your thoughts on the current market, your questions and queries about where is best to buy in London, and also just asking for Dennis and Sohail's and Sebastian's opinions. They've got a lot of combined experience. I won't add it up in total. So we'd love to hear from you, and we'll also be taking questions at the end as well. So I will let Dennis take the first question. So Dennis, I'll pass on to you.
Okay, thanks. Yep. Okay. To everyone who is tuning to us today, welcome. We want to keep this as a very informal chat between Sohail, Sebastian, and myself. Obviously, in the course of this year, we have been talking to a lot of clients, and we have been receiving a lot of different queries. So we want to take this opportunity to maybe just answer some of the questions that we receive quite often, given especially the backdrop of what's going on right now in the world. Obviously, for one of the number one questions that always come up is this the best time to invest in London properties? Sebastian, you know, I'm sure you get this a lot as well, being in London and the clients that, so you know, maybe you can share, like, what do you have, what have you advised clients?
Yeah, I mean, look, I think for me, it's, you know, I've always been taught, as being 20 years now as an agent, that there's never kind of the right time or the wrong time to buy in London. It's kind of as and when, but there are facts that, you know, that support what's been going on in London over the last 300 years. And typically, you know, kind of really putting it to simple terms, it seems to double every 10 years. But part of today, and part of the reason why we're all here, is that we're kind of really picking out a spot in London that we think is going to see quite a lot of growth, because obviously areas of London grow constantly, and it seems to kind of go into trend. You know, one time it's East London, kind of the Canary kind of Canary Wharf area, then you've got Battersea, South West London, and now we're starting to see huge trends start to develop over to Wembley. And that's kind of, we've tracked that over the last 10 years how things have really increased quite substantially. And that's why we're here today to kind of have a conversation with all of you lot to kind of say, well, this is something that you, as an investor or someone who wants to buy something, is a good indication to kind of pinpoint.
Yeah, I guess, you know, from my perspective, because I'm talking to clients from around the world, whether from Asia or Middle East or everywhere, London has always remained one of the most popular destinations, even though we represent properties from 14 to 15 different countries at the moment, in Europe and Asia. But, you know, every conversation that I have, you know, always steer back towards London, because I think most of investors, international investors, they regard London as a safe haven. In terms of a real estate market is very mature, and there's a high level of transactions. So in terms of timing, this is what I advise most clients, that there's never, I mean, what most investors try to do is they try to time the market, which in my opinion would be quite a futile strategy. Because I think for real estate, how I advise clients is to take a long-term view. Because if you look at the screen right now, this is the long-term 20-year price chart of London real estate, apartments specifically. So if an investor had come into London in January year 2000, at the turn of the millennium, the average price of a London apartment starts at about £115,000. So as you know, everyone can appreciate, in the last 20 years, there has been a lot of significant events that has happened in the world. You know, going from the crisis in early 2001, I mean, in September 2001, you know, there have been wars, there has been different kind of, obviously in 2008, the major event of the global financial crisis. But if you look at the graph, this is the graph that's coming out from the land registry, the long-term trend is up, simply because of the demand, underlying demand in London itself, and of course other factors, including the quantitative easing that has taken place in year 2008. So as an investor, each time there's a crisis, you would think that, hey, you know, maybe I should wait out a little bit more, maybe prices will take a dip. But if you look at the price chart here, out of the 7 major crises that has happened over the last 20 years, the prices has only dipped twice. And in the most recent one, where we have this major event of Brexit, prices did not really fall off a cliff. It has softened in general, but it has not fallen off a cliff. So this goes to show the underlying demand for real estate in this city. So I think some of the points that sort of like the drivers to keep that I see, you know, as an investor, that why this might be the best time to jump in, because obviously given the pandemic that we are experiencing right now, most of the governments around the world are injecting huge amounts of liquidity into the market. It started off in 2008, actually, after the financial crisis. The UK Central Bank, the Bank of England, came in with £200 billion. And that amount of money came in and it flowed into both the stock markets as well as real estate. And you can see from 2008 up to 2016, 2017, the prices have gained almost 82%. So, and that is from the quantitative easing that has taken place in the last 12 years. Now, with, you know, up to June 2020, the announcement by the Bank of England has been £745 billion will be injected into the market. From my perspective, if an investor were to take a 5-10 year view, chances are that, you know, prices will probably, you know, be on an uptrend. Now, people will be saying, now maybe I should wait a little bit more, or, you know, should I maybe wait 6 months or whatnot. So the truth is no one really knows, but I think if to stay invested within the market would be my advice. You know, what do you think, Sebastian?
Yeah, I think, you know, we've you know, I've worked in most of in quite a lot of the downturns, and we've always seen kind of a flat plateau over a big crisis, and then with this really sharp increase. And I think if we just look at the now during the pandemic, you know, we were all expecting for the worst. And actually, what we have seen probably in the last 4 months is the market really rally, and a lot of deals being done. So it fills me with confidence. There's nothing really kind of too toxic in the foreseeable future to really affect the London market. I think there's also the adage that London is such a safe haven, as you pointed out. You know, we've got a very stable government, and that's a big attraction. The education system here is still really sought after by lots of different markets. We're seeing obviously things around the world with Hong Kong, and the potential of 3 million people being granted visas. Again, another influx of purchases coming to London. And because you've got all these markets around the world that are constantly being affected and drawn back here, and there's even if you look at London as a whole, it's a big city, but every year there's still a shortage of property being built compared to the demand that we have. And it's the old adage of, you know, supply and demand. As long as the demand is high and supply is low, there was always going to be an increase in price, and that has been the trend for very, very many years. Even to most pundits, especially the press that love to slate London, and they get a bit of a kick to sell a few newspapers, I think London is still very, very resilient. And I've had lots of meetings with very kind of senior top level individuals who, you know, who, dare I say, coined it, it's quite bulletproof. And I seem to agree with that. And, you know, from your graph that you kind of put there, everyone, that's pretty evident. And it's one of those markets. There's only a few markets in the world that have that. I mean, just looking back, just to give you an example, you know, if you bought gold 10 years ago, you'd have made an 80% increase in value. And with going back to Wembley, what we're focusing on, you know, if you bought a property in Wembley 10 years ago, you'd have made 234% increase in value. So it just goes to show you how solid that actually is. And it's something that, you know, there are very clever individuals out there who buy long-term hold and keeps, and effectively they always seem to make their money over time. I think there's a difference to looking at this graph and looking at, you know, the long-term investor that won't lose out, and then there's the short-term hold investor who looks to flip contracts in the short term, and that's when you will have the negative equity, and that's about timing things correctly. But that's a completely different subject, a completely different webinar.
Yeah. So I think you point out something that's very interesting as well. I'm sure for our audience who's tuning in right now, like from our perspective as being the professionals on the ground, we are seeing an influx of interest coming in from Asia, especially. I think in Asia, they have probably handled the pandemic relatively well, and we are seeing a hive of activity. In fact, this coming weekend, we're having an event in Hong Kong, and my update as of this morning is we have more than 130 people who have expressed interest to want to attend and find out more about the projects that we are recommending to investors at this moment. So a lot of all this data is not really seen, not reported out in news. I mean, people are still going about the doom and gloom. But you know, I think it will be interesting for our audience as well. I mean, to our participants today, to know that actually, you know, on the ground there is really activity. You know, people are still inquiring. London still remains an attractive market. In fact, maybe I'll just bring in Sohail at this point. I think you have been serving a lot of clients internationally as well. So exchange rate has been something that is a topic that's come up quite a bit, right, Sohail?
Yeah, I agree with most of everything what you said. I think what we see in addition to that is if you look at the graph there in conjunction with, say, 2008 and onwards, rates, as we all know, have been reduced, and now we're at record low levels. So for a non-UK borrower and a UK borrower, interest rates are at record low levels, and you are able to fix rates for 5 or 10 years, so match your medium to long-term strategy. I think with the currency, again, yes, if you go back to June 2016 with an event like the Brexit referendum result, the currency fell by 20%. So overseas investors not only benefited from lower interest rates, but also a cheaper currency conversion. I think the currency currently with the current pandemic has been a bit stable, but nonetheless, yes, we as a broking firm work with both clients from overseas and the UK, and consistent demand from the Middle East and Far East has continued, and as coupled with lenders seeing that as an opportunity to get more money out the door. So our lender panel who lend to clients from those sort of jurisdictions has increased as well. And they get comparable rates to what is available for UK borrowers.
I think this ties in, like the timing of whether this is the best time to jump into London real estate has got a lot to do with both the exchange rate as well as the borrowing rates, which I think would be another question that a lot of our clients do ask. So maybe Holly, you can bring up the next question.
Yeah. Great. Yeah, so this is a question for Sohail, and this is a question that we do get quite frequently about what's the process and what rates can be expected. So Sohail, I'll hand it back to you.
Yeah, so just as a quick intro, so I'm from Springtide Capital, one of the UK's leading mortgage brokers. We cover all areas of property finance. We work with mainstream, high street, private banks, and building societies, and we are authorised and regulated directly by the Financial Conduct Authority. So my job, in short, is to work with clients, both UK and non-UK, understand your requirements, and then formally research, recommend and arrange the most suitable, most cost-effective mortgage. Before we go directly to that question, I guess a bit of an update post-COVID in the mortgage market. Overall, it's relatively positive. Lenders have remained in strong positions. There's no sort of banking contagion, and there is strong liquidity. That's primarily, I would attribute to the changes that were enforced post-2008 with the EU directives and ring fencing and capital adequacy ratios. So this new sort of scenario that we're facing hasn't had an impact on banks. In fact, interestingly, the Bank of England base rate was cut to a record low of 0.1%, the lowest in history, and that was cut from 0.75%. And that in turn had a knock-on effect to the cost of borrowing for banks themselves, the swap rate. So actually, it's now even cheaper for banks to borrow on the markets and then lend to consumers and borrowers. So interestingly, the profit margins for lenders has increased post-COVID. The good news for you and I is that they have passed on that lower cost of borrowing to us borrowers. So we have seen rates come down, and you can see 5-year fixed rates for UK borrowers and in some overseas countries as low as 1.4%, and 2-year fixed rates around the 1% mark. Indeed, post-COVID, lenders, from a risk point of view, they will want to understand a bit more on the impact of COVID and a person's income moving forward, be they employed or self-employed. And so long as both the borrower and the bank are comfortable that there's not a huge impact, then deals can be done and mortgages are being provided. There are 2 or 3 maybe banks still who have suspended operations, but that's natural, and they're going to see how the land lies and then return to the market. But as I say, overall, it's very, very positive from a mortgage market perspective in the current sort of pandemic and crisis. Specifically for non-UK resident mortgages, yes, is the short answer. A big factor will be the country. Some lenders will generally operate an approved country lists where they will work and where they won't work. But some key facts for non-UK borrowers in general, these, I must stress, it would be case specific, but just some high level sort of factors for you to sort of take away is if you're buying for your own occupations, that can be for your own family use, a student, a child studying in the UK, or a holiday home, we can go up to 85% borrowing. It'd be very much determined on the purchase price level. For buy-to-lets, however, 75 would be the maximum. So that's the percentage you can borrow for each particular use. Then the amount you can borrow for non-UK residents is very much linked to your overall affordability. So what I mean by that is the banks want to understand your income, your outgoings and rent or mortgage where you live, as well as the rental income on a buy-to-let investment in the UK. Indicatively, as a rule of thumb, the borrowing can be between 4 to 5 times your income. But as I say, that will vary on a lender by lender basis. A lot of our overseas clients will want to purchase the property in different ownership structures. So we can assist there, and that you can buy the property in your personal name, in a UK limited company or special purpose vehicle, or also an overseas offshore entity. Typically, this again will vary, but you can borrow up to age 75. Some can go a little bit beyond that. Some will be at 70, but on average would be 75 years. And then on the interest rate types, the UK, unlike other jurisdictions in the US or Europe, I know they're long-term fixed rates. Here, it's very different. The mortgage, as I say, the commitment can be to age 75, but the interest rate options would be you could either fix it for a period of 2 years, 3 years, 5 years, or at the maximum a 10-year fixed rate, or you can have a variable rate, which is where you attract the LIBOR rate or the Bank of England base rate. As a rule of thumb, the longer you fix the interest rate for, the higher the rate would be. And so those are just some sort of high-level key facts for non-UK resident borrowers. As I say, it's very much case specific, and we'd want to, seek our service from the clients to give them a proposal on the best options out there before they start a property search.
Great, thank you, Sohail. There was a question, but I think we answered that. It was about the loan to value, and so Sohail is from Springtide Capital. So anyone that wants to get in touch, then let us know. We can organise personalised consultation and take you through based on your situation and scenario. So thanks to everyone who's asked questions. We'll just take a bit of a break to answer those now, but feel free to kind of keep asking throughout. So we have a question here from Yusuf. My apartment in Wardian is due to be handed over in November, and I want to know if the proposed stamp duty holiday will apply to me. Some detail here: exchange of contracts took place in April 2018, and I have paid my deposit and I'm due to pay 80% on completion. So Sebastian or Dennis, could you
I'm happy to
answer
jump
that?
on. In theory, if the Chancellor does announce that we're going to have a stamp duty holiday, then yes, it will apply to you. It's up to 500k, and then obviously it'll be done above that level, whatever you've purchased for. So you'll see a reflection in that, obviously. So that would be good news. And obviously that's another thing to mention, that if this announcement gets made in the next few hours and days, that will really impact the market quite significantly, because that's quite a big hit to kind of surge the market forward. Something else that Sohail mentioned, which is also worth noting, and I think for people that are investing, is that the UK banks, there's quite a few of them have agreed 90% loan to values, which means that they're prepared to lend 90% of the property's value. And if you know banks as well as we do, they don't really tend to take much risk. So they have definitely a confidence that the property market will not go into negative equity over the next 2 to 3 years or 4 years. So that gives me some comfort as well for people looking to kind of think, well, if you have that so-called crystal ball, which unfortunately no one does, what's going to happen? I think you can take comfort from the fact that banks are feeling confident about the property market.
Yeah.
That was my point.
Yeah. I think in summary, I mean, we have been, for people who have just joined us, the point that we're bringing out is that with the combination of so much liquidity in the market, as you can see, banks are lending aggressively with such low interest rates, with the amount of money supply in the market, with stamp duty holidays, and the government actively trying to grow this to promote the real estate market in UK, in London. So I see, all these are good factors that will contribute to support the market, at least in the next 5 to 10 years. So any investors who's looking to get in with a long-term view, I think this is probably the best time, with all the stars aligned in our favor.
Storm, Dennis. It's the perfect storm.
I'd like to say that the stars are all aligned for property investors, especially those who are sitting on cash. Yeah, this is probably the best time ever.
Yeah, I think the main thing about London right now is that London is got so many different areas and zones, and every area goes up and down. And you've got to find the right area to focus on. And it happens, and it's happened through the 20 years that I've been an agent. You see different parts of London really rally. There are certain parts of London, prime London, that are very tight, and you might be lucky to get 1 to 2% growth in a year. Whereas you go to other parts of London, you'll see 5, 6, 7, 8, 9, 10% go up in a year. So it really is dependent of where you go and put your hard-earned buck into, what parts of London. Yeah. And there's something for everyone. A couple of years ago, I would have laughed if you said to me 4% plus yields. And there are areas in London now that we're seeing 5.5, even in some cases 6% yield on the rental returns, and that's happening right now. So there are those locations. Even developers are prepared to put 2-year rental guarantees for certain people, so for investment. So it really is the right time to purchase if you're in that position.
I think this brings us probably to the next most popular question that we keep getting.
Yeah,
our clients.
definitely. Yeah. So which locations should I be looking to invest for capital growth? So I'll let that go out to the floor for Dennis and Sebastian.
I think we get this a lot, whether for clients who are looking at both capital growth and also for the rental yield, for high rental yield, so that they get a good net cash flow for the investment. So I think Sebastian, being in London and with your experience on the ground, maybe you can share a little bit on this.
Well, I've just seen a question from Lau Damal regarding following Wembley. What areas in London might show great future growth? It's all about infrastructure, Lau. It's where part of the big growth in London is where we've seen Crossrail. So that east to west development of Crossrail is where we've seen the biggest growth. So following that line across London, you'll see where the under invested areas have started to see the biggest kind of explosion in investment, in developers purchasing land, regenerations of areas, and that's kind of where we've seen the biggest focus. There's two parts to London. You've got the prime, the old bit, which is kind of zone 1, zone 2, which has been kind of bulletproof for many years. But what you'll have there is probably a much more solid, it's like a bank. If you want to leave your money somewhere and let it grow over 10, 15, 20 years, then you go kind of zone 1 and 2. If you want to see a little bit more rapid growth with a little bit more risk, you go to zones 3, 4, and 5. Ultimately, I think 5 is not developed yet, but it will be. But I think zones 3 and 4 are certainly areas that one should be looking at. And then obviously where the infrastructure is, so good transport links, easy access to the airports. There is more than just development, but there is kind of other things, for example, like retail, commercial, and things like that. That's something that I'd be looking for. And you can obviously come and speak to us directly at Chestertons New Homes, and we'd be more than happy to point you in the right direction.
From my perspective, whenever I speak to our clients who are based overseas, the foreign investors, the locations that I tend to recommend would be areas where you see regeneration, where there's a master plan. So some of the very successful master plans that have taken place in London are, for example, Battersea, where Google is the master plan, Battersea Power Station. So Apple is moving their headquarters there. There's going to be a lot of new jobs. There's going to be basically a new destination. King's Cross comes to mind. It has been very, very successful master plan where Google's HQ is now, Facebook is there as well. So I'd like to recommend clients to go into regeneration master plans because you get new jobs, you get price appreciation coming into these areas. So one of the areas that personally for me that I like a lot is Wembley. This is a master plan that has started in 2005, 2006, obviously with the reconstruction of the iconic Wembley Stadium. So we see a lot of new residential offices. There's even a destination which is a London designer outlet where you're seeing almost 7 million footfall in a year. So tourists from all around the world, they come here to shop. So by investing in an area like this, if you can hold out for, again, 5 to 10 year horizon with an investment view, so chances are your properties is going to appreciate in value. So this would be my recommendation.
Yeah, that's great. That actually, we've got another question that ties in quite nicely. It's from Anonymous, but it says, are riverside properties in areas like Staines expected to show good future growth?
So I can take that. Staines has seen some really interesting investment. In the last 3 years, you had London Square going to Staines, now followed by Berkeley, and Berkeley don't tend to go into areas that they don't think is going to grow rapidly in capital growth. So they tend to kind of judge the market very well. So I think Staines definitely see growth for sure. But also part of the benefit is the Crossrail link. It's going to surface Staines. So Staines is definitely a location that would, if you're looking at, I think it's got good future growth for sure.
Great. Thanks, Sebastian. So I think we'll move on to the next question as well, which kind of ties in all of what we've been discussing today. So which projects do we recommend? What should people be looking at?
Yeah, I mean, yeah. So again, I mean, this ties in quite well. Again, with all the data that we are seeing in the market, and not just from us, also from the mass media that a lot of our clients are looking at. So naturally, this question comes to us, like exactly which area, which projects do we recommend? For myself, right now at this current moment, as I mentioned earlier, Wembley is a destination that I really like. We are representing a development called Signal Con, which maybe Sebastian can touch on a little bit more as well. Our team has been pretty successful. In fact, we just closed a unit just last week. An investor who came in and bought out a unit. So maybe Sebastian, you can tell us a little bit more about this.
Yeah, so Signal Court is kind of a boutique development. It's like 34 units, and the reason why I really like it, it's because it's in prime zone 4 location. You are, I think, about 9 minutes away by public transport to Marylebone, about 18 minutes to Baker Street. It's got brand new, I mean, as you can see, it's an 8-story apartment building. There's 2 retail units and car parking spaces. It just has the right sort of mix for what we think is kind of and I think the price points actually on this development are really good as entry-level pricing points and generous kind of spaces. And I think that's quite crucial for any sort of investor. And obviously, one other big thing is you can purchase it now and complete this year. And to find developments in London that complete this year is quite difficult. So taking advantage of, as Sohail said, the advantageous interest rates, of the surge in the rental market. The rental market at the moment is outperforming sales nearly 3 to 1 because there's a huge demand for rental property and there's a huge shortage of rental property. So if you're looking to obtain something that you can service that demand, this is what we think is a really prime example of a good quality developer and development. So yeah, it'd be certainly something that we're going to kind of break into a little bit further. And actually, because we understand that you can't get that much information from a 30-minute webinar, my team are happy to kind of give you all a call and just go through certain units that are basically we're going to be discussing today. You can see also kind of a breakdown of what it would cost to get into one of these apartments. Sorry, I've just opened something random on my computer screen. But yeah, it's all pretty explanatory. Initial reservation £2,000, 10% on exchange, which is quite standard, and then 90% on completion. That would be obviously Q4. So you've got a couple of months to sort that out, and an estimated return of £350 per week, and that's rough. You might be able, depending on kind of supply and demand, to get a little bit more than that, but it gives you a really generous yield. And this is what I was saying earlier, close to 5%, which is phenomenal for a London location. So it ticks a lot of the boxes.
Yeah, I fully agree with Sebastian on this. This is I think for a first-time buyer, someone who is coming into the market for the first time or wants to sort of take a little bit of a calculated risk without risking too much capital. With an entry price of 370,000 pounds for a high-yield investment property, well located, I think this is one of our recommendations at this current moment. In terms of rental demand, being in this neighborhood, there's a real demand, right, Sebastian? Because people are looking for houses where, they do need a roof over their heads. It's not as speculative.
The council, Brent Council has spent about 1.5 billion since 2002 in regenerating Wembley, and they're trying to kind of create another zone a bit like Stratford. But Stratford was always a bit rough around the edges. It was a little bit further out, and this is a lot closer in with a much better link. So there's that uplift. Also, there's been a really good news story about the housing prices. 10 years ago, an average house price in Wembley was about 130-ish thousand, and now it's kind of close to 500,000. So it's still under the London generic average house price. So there's still growth there too. So as you've got bigger developers now moving in, and what tends to happen in London is that you'll get the smaller, more domestic developer move in, do developments like this, and then you've got the big boys following, and then first phase, second phase, third phase seems to be those price increases. So before you know it, you know, if you were to try and buy something similar like this with a bigger tier 1 developer, you'd be probably paying another 100, 125, 130 pounds extra per square foot. And that tends to be the case. So we're following a trend pattern. So we're trying to say, look, get in early before the area starts to really go up.
Yeah. We're seeing quite a lot of questions coming in, which is good. So for any of our participants, you can just click on the Q&A button and you can just type it in. Yeah. I think we've pretty much covered all the very common questions we are getting off from our investors. So maybe we can take this opportunity to just pick up some of the questions that are being asked live.
Yep, definitely. Okay, so we had a question from Charu earlier, so now's a good time to answer. So this is quite topical at the moment. Is it a good time to sell your property, or is there likely to be an increase with the Hong Kong visa allowance?
Maybe I will step in on this question first. I'm sure for people who are following the news, they know that the UK has now allowed Hongkongers who actually has the BNO passport to come into the UK, and they can take up residence and they can eventually even take up citizenship. So whether it's a good time to sell, Charu, if you're currently owning a property in London, one of the strategies that a lot of investors do is they trade up. So if you're, for example, you own a 1-bedroom apartment, you can sell it off now, and then you take whatever profits that you are sitting on the property, and then you grow it up into a 2-bedroom apartment, for example. You can go for a new build. That is usually what I recommend, because less maintenance problems, good areas, great facilities. So you can do a trade up, sell off the 1-bedroom, grow into a 2-bedrooms if you have a long-term view again. So then you can maximize your profits down the line. So this would be how I would do it. How about you, Sebastian? What do you think?
I think you won't see an increase in price. What you will see is that you'll get closer to your asking price. That's what I see in a lot of these markets. So with buyers, with a kind of influx of new buyers coming into London and into the UK, you'll find that the negotiational aspect advantage that you used to have, when you might be able to get 5-10% reductions, will get smaller as more people buy. But if you're selling personally, you'll find that you're more likely to get either close to your asking or above your asking, and that means that we should see a little spike. It will be quite. There's been problems in Hong Kong now for quite a while, so we've already seen a lot of that traffic come over into the UK for the last probably 6 months or so, 7 months. So that's already been a lot of the pricing has already been adjusted for what's going on. So yeah, is it a good time to sell? I mean, look, we're calling it a bit of a fat cat bounce. We've definitely seen a lot more activity in the last 3 months during lockdown beyond any experts kind of advice. I mean, we surprised a lot of the market at the moment in terms of what's been going on in London in the last couple of months. Sales has definitely been as busy or busier than we had this time last year, especially over the last 2 months. So it's a good time.
Yeah.
Put it this way, I'm selling one of my properties at the moment in London, so just take advantage of it.
That's a good sign. Thanks, Sebastian. Thanks, Dennis. Just a quick question for Sohail. Does Springtide do bridging loans?
Yes, we do bridging loans for UK and non-UK borrowers. The bridging market has expanded over the years, so the rates have come down, so it can be quite competitive. But yeah, absolutely, we can do bridging.
Fantastic, thanks. So we've got another anonymous question here. Are areas like Ealing W5 likely to see growth?
Yeah, Ealing's already seen quite a lot of growth. Will it see more growth? Potentially. It went from Shepherd's Bush, Acton, and kind of has come out to Ealing, and obviously Ealing is in the last 2 years has seen quite a lot of activity. It will increase, obviously, but it won't be as sharp as probably other areas like Wembley. I think you'll find that the more up and coming areas now that we'll see a much bigger growth in time. But yeah, it's definitely going to have some growth. Not as big as it has had, but it still will do.
Yeah, great, thank you. Do you want to add anything, Dennis?
Yeah, I think for Ealing itself, I think like what Sebastian mentioned earlier, the Crossrail story is very good. I mean, but I'm sensing that probably that has already been priced in at the current moment. My recommendation, again, as what I said earlier, would be to go into a master plan where you get a lot more going on for, let's say, the next 5-10 years. That would be my recommendation. Yeah.
Great, thank you. So we've got another anonymous question here. So, I have a property to be completed in Liverpool. Would you recommend selling it now or keep it keep now? Will have to take a loss, or do you think that prices won't drop too much?
The Liverpool saga continues. So Liverpool's a really funny beast. You know, there's a huge surge a couple of years ago, which anonymous attendee probably kind of went into. I think if it's a trustworthy developer, B, that there is signs of completion, that it's in one of the zones that have been highlighted as regenerative zones, I would probably keep it and kind of wait to see what happens. I think selling at a loss would be a mistake. I would definitely hang on to it. You know, there are a lot of the bad press about what Liverpool's received in the last 2-3 years will dissipate for sure, and the parts of Liverpool that have been promised to be regenerated, once they've regenerated, I think that's when the market confidence will start to come back. So I think if you can hang on to it and it doesn't cost you too much financial distress, then keep it.
Yeah, great, thank you, Sebastian. Dennis, anything else to add?
Well, I think the Liverpool's, you know, as part of the Northern Powerhouse story with the growth of Manchester and Liverpool, I think the positive press is that they have just won the Premier League, right? First time in many years. So yes, so Liverpool has been fairly, I would say, attractive to quite a number of investors and clients that we have out in the Middle East for a couple of reasons, being a low entry point, and there are also certain developments that promise a very high rental return. Really depends on the financial situation for this client that asked the question. As long as you have the financial capacity to hang on to it, why not? If you want to trade up, like what I mentioned to Charu earlier on, you could sell it and maybe move down towards London. That's also another strategy that you can take on. If you feel that, hey, maybe for whatever amount of money that I have as equity in this property, maybe I will do better in London in the next 5 to 10 years. That could also be something that you can look at. So I think for to have a real detailed conversation, I think definitely reach out to us in Chestertons. One of our sales consultants will be very happy to advise you on this, you know, to give you the proper advice. Yeah.
Yeah. Great. Well, unless anyone has got any more last minute questions, I will take it to the last slide. So as you said, Dennis, after this session, we'd be happy to take any questions, and our team will be following up with you all that attended and answering any more detailed questions that you have that needs a bit more in-depth kind of research about the locations, and we can provide a really detailed kind of proposal to you on projects and locations that we suggest for your budget. And again, Sohail can support with your mortgage application as well, so you can get everything done together. So yeah, I want to say thank you to all of our panelists today, Dennis, Sohail and Sebastian. I think it's been really insightful, and I think it's great for people to kind of hear from the inside, you know, inside the market, and hear some positive news as well. I think that's fantastic. So I'll thank you all, and thank you everyone for joining, and please do get in touch if you have any questions. So thanks, and enjoy the rest of your afternoons.
Thank you. Take care.
Thank you. Thanks, Ollie. Thank you.
Bye-bye.
Bye.
Bye.
Pleasure. Take care.
Bye-bye.